All right, thanks, David. Great to be here as always. Welcome to all of you. A lot of great stuff to cover on the session today. So I love doing these events. I'll give you a little bit of background on myself, but I am Jeff Tompkins with Altos Trading, and we're going to be discussing forecasting trends up to 3 days in advance with Fibonacci. And we can actually, in many cases, get more advanced than 3 days. But we're going to look at kind of the methods for doing that and how to throw all the lagging components out the window and really focus on forward-looking forecasts. All right, so before we dive in, I'll just cover a quick disclaimer with you. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options. Of course, need a broker to trade securities and options and must meet suitability requirements. Past results are not necessarily indicative of future performance. Although performance figures may be based on actual trades or hypothetical results, due to the time-critical nature of trading, brokerage fees, activity of other traders, we don't guarantee that anyone will mirror the performance of what we share in the session. So this is intended to be used as educational information and not to be construed as individual investment or trade advice. All right, so before we dive in, I'll just give you a brief background on myself. Again, I'm Jeff Tompkins. Welcome to all of you. Great to have you guys here today. I have over 2 decades of experience trading the stock options and futures markets. Received my professional training as an intern at the trade desk at Morgan Stanley back in the early 2000s. And we're coming up on our 10-year anniversary. About a decade ago, founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And I'm the developer of the price action pivot indicator, which we're going to be incorporating into the Fibonacci strategy that we'll cover on the session today. So let's start with that. If you've used Fibonacci in the past, okay, you might find on our session today that you've been doing it all wrong, or you might find that you weren't optimizing your entries, your defining your risk or setting realistic profit targets using the tool. Because the challenge with Fibonacci is that there's a lot of subjectivity behind it. Unlike a lot of other indicators like a MACD and RSI, a stochastic, right? It plots on your chart in a fixed mode. So you're not, unless you manipulate the user inputs, you're not changing that. Whereas with Fibonacci, it's a drawing tool. So there's subjectivity behind where you start, where your Fibonacci starting point is and where the end point is, where you draw that Fibonacci retracement line. So we're going to solve that problem today. Okay. And so the way we're going to do that is using what I call price action pivots. So there's a few things we need to know, right? We need to know when to buy, when to sell, but also when to stay out of the market. Okay. And that's obviously the main reason that we trade is it gives us that edge to be involved in the market when conditions are favorable and stay out when they're not. All right. So we're going to look at how and why periodicity highs and lows provide crucial trend and reversal forecasts. How to identify when markets are likely to reverse trend. Okay. And this can completely turn your trading around because if you're, placing directional trades, you obviously need to know the momentum strength, the trend direction, of course, but when is this going to reverse? Because ultimately, all trends come to an end and reverse. How to identify key supply and demand points? So the pivots are going to give us a good indicator of a shift in supply and demand and when a trend is likely reversing. And then, again, we're going to tie that into the Fibonacci tool. It's also going to help us set accurate entry, stop loss, and take profit levels. So as market trends prepare to reverse course, there's a shift in supply and demand, right? And we can actually see clues of this inside the candlesticks on the chart to give us an idea of future directional movement. And so we're going to use a 5 candlestick pattern. And I put in parentheses minimum because there are some exceptions, which I'll explain, to identify when these trends are likely to occur. And then once we get a completed pattern, we have a blueprint for forecasting directional trend. All right. So that's the first step. And we're going to, again, throw all the lagging indicators out the window. We are purely using price action. Okay, nothing else. So no lagging components. And it only requires a basic candlestick or OHLC or open, high, low, close chart. Okay, that's all you need. What we're going to be doing is tracking changes in candlestick highs for short setups and candlestick lows for long setups over 5 candlestick periods. And again, I'll explain what I mean by minimum. Price action pivots can predict market shifts with incredible accuracy, and it can be applied on any retail trading or charting platform and help us identify those shifts in supply and demand. And then once we've identified those and forecasted a trend direction, we can then apply Fibonacci to determine optimal entry points. This can be applied to any asset class, equities, ETFs, futures, Forex, any time frame. So whether you're intraday trading, we're going to mainly be looking at daily charts on our session today, but doesn't matter if it's a 5-minute, daily, weekly, monthly chart. Okay, so we're going to do most of our session right out of the charts today. So let's get over to those and we'll talk a little bit about how to identify the shift in supply and demand in a valid pivot point. Okay, so I've got a chart pulled up of the S&P futures. Okay, so the first thing we need to do is identify the market structure. Okay, that's critical and an often overlooked step in the trading process, right? We need to know what the structure is. Are we in an uptrend, a downtrend, consolidation, and so on and so forth. So let me actually zoom in here just a bit so we can see this a little more clearly. And these pivots are all over the place, but I'm just going to maybe just pick one out here. Expand the chart a little bit. There we go. All right, so market structure. We'll just start right in the kind of middle of the chart here. Okay, so I'm going to be looking at this area of the chart. Okay, and we're going to start with a bearish pivot. So first step, market structure. What's happening here in early February? We are making a series of higher highs and higher lows. Okay, and again, this is a daily chart. All right, now on February 20th, something changes. We put in a lower high and a lower low. Okay, so there's a shift in supply and demand at this point. Okay, there was a prior uptrend, and now things are starting to change. Okay, so there's probably fewer buyers, more sellers. Okay, and there wasn't enough of a bid to propel the E-mini S&Ps higher to put in a new daily high, right? So there's that shift in supply and demand. Okay, now for a bearish pivot, we're mainly concerned with the candlestick highs. So this is actually a great example because in this case, there was a day where there was a lower low relative to the prior session. Okay, that's perfectly fine. We're mainly going to be concerned with the candlestick highs. Okay, so we put in a series of higher highs over 4 or 5 trading days, and then on February 20th, everything changes, right? We put in a lower high. Okay. So what we want to do at this point is begin tracking these candlestick highs. So if we go to the prior trading day, so this is going to be on February 19th, we're going to mark this as our potential pivot. It's not yet a confirmed pivot, and I'll explain why. We need to have 2 lower highs to the left of a pivot candle, a bearish pivot candle, and 2 lower highs to the right. So on February 20th, we're close. And this is when I mentioned the 5 candlestick pattern, this is what I mean. So we need to have one more day of a lower high. And sure enough, that comes in on the next trading day, February 21st. Okay, so we now have 2 lower highs relative to the pivot candle to the left and 2 lower highs to the right. Okay. This now becomes our confirmed pivot candle. Okay, so we have a confirmed bearish pivot. Now, the expectation here in the forecast is a further move down in the security. When I use this process or an approach as a standalone, the follow through I look for is a break below. So again, for a bearish price action pivot, the low in the 5 candlestick pattern. Okay, so let me just clear this out to make it a little less messy here. So here again is our 5 candlestick pattern. Okay, and in this case, the low, so here's candlestick 1, 2, pivot candle, 4, and 5. And in this case, the low in the pattern happens to be candlestick 5. That's not necessarily always going to be the case, right? The candlestick 1 could be the low, for instance. But we're going to take the low in the 5 candlestick pattern. And then we're going to look for follow through in the case of a bearish price action pivot to the downside. Okay, so what I'll typically do is use what's called a sell stop order. Okay, because back here on February 21st, right, we didn't know, obviously, at that point in time where the E-mini S&Ps were going to trade the following day. They could have very well, gapped higher and then resumed the uptrend. So by using a sell stop down below the low of the 5 candlestick pattern, right, we have to get follow through to get a triggered entry where we hit that entry price level. And a high percentage of the time when that occurs, you're going to get follow through to the downside. Okay. All right. Now, I'm not sure that I'll be able to quickly find, let me see if I can find an example of the exception. Oh, actually, well, would that be one? Let's check this one. So here we had a low 59.17. No, that one broke. I don't immediately see one. They don't occur all that frequently, but the exception is an inside candle. So that's where you might exceed a 5 candlestick pattern. So essentially, we ignore inside candles. Actually, here's one. So here's a bullish pivot. All right, and if we look to the left of right, we had a prior downtrend. That's the first requirement. We're actually just going to, so it's the opposite of a bearish pivot. We're going to track the candlestick lows. Okay, so we're making a series of lower lows. Here was an inside candle, so the high-low range resides within the high-low range of the prior candle. Okay, this otherwise would have been candlestick number 1 in the bullish pivot, right? But we ignore the inside candle because they predominantly indicate indecision and tend to carry less weight when it comes to price action. So we're going to ignore this. So this would actually be candlestick 1. Okay, ignore the inside day. Candlestick 2. Okay, remember back at this point in time, so this would have been early January. We didn't know yet that the January 13th candlestick here was going to be a bullish pivot candle, right? We just are simply tracking the lows here. Now, on what day was this? January 14th. Okay. So we're transitioning from January 13th to 14th. This is where everything changes, right? Instead of putting in another lower low, we put in a higher low. All right. So that now becomes candlestick 4. And this is our potential pivot candle. It's not confirmed yet because what we need to have happen, we need to have another higher low, which we get the following trading session. And this becomes candlestick number 5. Now, one thing to point out here, and a question I often get, the lows here. So, for instance, candlestick 5. It just happens that this is a very nice, pretty bullish price action pivot, but the low of, say, candlestick 5 doesn't have to be higher than candlestick 4. In fact, let's just say candlestick 5's low was down maybe right about here. Okay. As long as it's higher than the pivot candle, it qualifies. Getting a bit messy again there, so I'll clear that out. Okay, so again, ignore the inside day. We have candlestick 1, candlestick 2. At this point in time, we just have a potential pivot candle, candlestick 4, and then we have a confirmed six candlestick pattern because we ignore the inside day, and we have a bullish price action pivot. Okay, high in the pattern, it happens in this case to be again a candlestick 5 entry there. We look for the follow through here. We use what's called a buy stop order. Okay, so we use a buy stop, and then we enter if we get the follow through. In this case, we happen to get it the very next trading session, and we have a beautiful move to the upside. Okay, so those are a couple examples of a bullish and bearish price action pivot. So again, I'll just kind of quickly recap, and then momentarily we're going to tie in Fibonacci, and you're going to see how incredibly powerful this is. So again, for a bullish pivot, we need a prior, start with market structure, right? So we need, what is the market structure? Well, bigger picture, right? We're getting a series of lower highs and lower lows. So we have a well-defined technical downtrend. Okay. Okay, so we're what? We're tracking the, oops, sorry, clear that out. We're tracking the candlestick lows, right? We're making a series of lower lows, ignoring inside candles, and then looking for that shift in supply and demand. There weren't enough sellers at this point in time to continue to propel the price lower, and the E-mini S&P start to catch a bid. Enough buyers come in, the supply-demand curve shifts, and we put in a higher low. This becomes our potential pivot, and we're just waiting for that final candle for confirmation of the full price action pivot pattern. Okay, and then just the opposite with the bearish. Okay, and as you're learning this, now you can you can spot these all over the place. So right here was another beautiful bearish pivot, right? We're making a series of higher highs. We ignore the inside candle. Here we put in a lower high. Okay, so now we should start paying attention. In fact, this is a great example of how this approach can help keep you out of bad trades. So here we did put in a lower high. So this what becomes our potential bearish pivot right here because we put in a lower high. But what do we need to have happen next? We need to put in another lower high. Well, the next day that didn't happen, right? We didn't get a lower high. We got a higher high. So this is now null. And it would have kept us out from shorting at that point in time. Now, eventually there was another good short opportunity, but we'll get to that. Okay, but I want to kind of walk through this to show how it can keep us out because there was a very strong downtrend and it looked like, hey, this is just a counter trend retracement that's going to resume back to the downside. Well, ultimately it did, but our timing would have been way off if we jumped in when we put in this lower high. So instead, what happens? Okay, now we have a higher high, higher low. Okay, this now becomes a potential bullish pivot. Okay, we have, again, we're ignoring the inside candle. And another great example, because candlestick 1 has a low that's lower than candlestick 2. But that's okay, as long as it's below, or sorry, above the potential pivot. So candlestick 1, candlestick 2, potential pivot. We put in a higher low. This is now a potential bullish pivot, candlestick 4. And sure enough, we get another higher low, candlestick 5. We now have, clear that out, a confirmed pivot. Now, if we use a buy stop, let me clear that. There we go. Right, our buy stop goes above the high in the pattern up here. We don't follow through. Once again, kept us out of a bad trade. Here's where the downtrend resumes. So we start the count over, right? We were putting in a series of higher highs. Okay, then we put in, and let me just verify this. Some of these are pretty close. So high 58.37, 58.36. Yes, so we put in a lower high. Okay, this is now our potential pivot. We start the candlestick pattern count. 1, 2, potential pivot, 4. And then we just need that final lower high. There it is on the next session. Candlestick 5, we have a confirmed pattern. All right. In this case, candlestick 1 is our low in the pattern. So we set a sell stop and we enter when we hit that sell stop entry level. Okay, below the low in the pattern. So see how it kept us out of some chop here. Okay, it kept us from taking a counter trend trade that ultimately would have failed and resumed back down. And it helped us time very well the resumption of the downtrend following the retracement. Okay, so even as a standalone, these pivots can be highly effective. Obviously, it takes some legwork to do all the candlestick counting and keep track of all this. So what I've done, I've actually developed an indicator that does all this for us. So it does all the heavy legwork. So I'm just going to go ahead and plot that on the chart here, price action pivot premium indicator. Okay, and it's going to, right, we just looked at a bunch of these. It's going to actually give us the bullish and bearish pivot points on our chart. Pretty cool, right? And so now we don't have to worry about counting candlesticks, paying attention to inside candles, so on and so forth. And the algorithm will then also calculate using volatility studies, average true range, so on and so forth, the price action to identify a viable entry level. So that's going to be the center dotted line here. It then will give us a stop level and a profit target level. These can actually all be adjusted in the user settings. But what I'm going to do real quick is we're going to now, in just a minute, incorporate Fibonacci. So I'm going to remove a couple things here. I'm going to take the boxes off, and we're going to take the entry, stop, and profit target lines off. Okay, so I'm only going to keep the pivot portion of the indicator on. So a bearish pivot will be a red down arrow. Okay, and a bullish pivot will be a blue up arrow. Okay. Now, here's where it gets interesting. As I mentioned earlier, one of the major problems with Fibonacci is where do you start drawing the Fibonacci lines and where do you end it? There's a lot of subjectivity behind that. So it can be challenging for Fibonacci traders to identify objective start and end points when we're looking for Fibonacci retracements. Okay, and so this is where pivots become critical. So I'm going to get to how to do that using this methodology in just a second. Now, I'll talk a little bit about Fibonacci. So I know that this event is really kind of dedicated around Fibonacci and also Elliott waves, right? So you may have already, if you don't have prior experience, learned some things from prior presenters. So the basics are obvious, right? We know the sequence. So I won't go into great detail regarding that, but I'll point out a couple interesting things. So if you're not familiar with how these Fibonacci sequences are developed and why they're significant. So the numbers are simply derived by adding up the prior two numbers. So, right, if you add up 1 and 2, right, you get 3. You add up 3 and 5, you get 8. Right, you add up 8 and 13, you get 21. Okay, that you can just keep doing that, and that's the Fibonacci sequence. And it's pretty cool. You probably know it occurs all over nature. And at some point in history, traders and investors started to gain some curiosity around how it would apply to financial markets. And interestingly, it was remarkably accurate in identifying retracements. And then also extensions, like for price levels that haven't even been reached yet. So it I always wonder with trading indicators or different tools, like, are they self-fulfilling prophecies, or is there actually something fundamental there that makes it a viable methodology? And so this was discovered that this was actually all occurring previously before anyone even started using Fibonacci in financial markets. But the other kind of cool, interesting thing is, so again, you take the numbers, right? Is if you we're gonna as we start to plot this on the chart, look at the different fib levels. But if you multiply any of the numbers in the sequence by one key fib level, and that's 0.618. Okay, if you multiply these numbers by that, you're going to get the prior number. It's kind of cool. So like it's not exact, but like I'll just show you here. Let me get a calculator up. Right. So like if we take 21, okay, and we multiply it by 0.618, you're going to get 12.978, right? So 13. So it's going to be the prior number, right? You multiply 8 by 0.618, right? You get 4.94. What's the prior number? 5. So that's kind of a cool thing. So you multiply any number in the sequence by 0.618, which is one of the fib levels, and you get the prior number in the sequence. Now, that's where we're going to start focusing in terms of fib levels. So this 0.618 is often referred to as the golden ratio. Okay. So 618 is a common fib level that's used. Now I'm going to show you kind of a different method, but we're going to incorporate this fib level. Okay. Another common one is the 50% retracement. Okay, so 0.5. Now, in between these two fib levels, 0.618 and 0.5, is what's often called the golden zone. Okay, so keep that in mind because the golden zone is what we are going to be using. Okay, so let's get started and we'll kind of take a look at some examples. Um, I don't really have necessarily anything pre-prepared, so I'm just going to kind of pick these out. But just know that um, we need to use the pivots is our first step. So we covered the methodology for identifying confirmed bullish and bearish pivots. I've plotted those on the chart here, okay, using the price action pivot indicator, so I don't have to do all the legwork. Now, here's where this solves the problem of where do I start my fib levels and where do I end them? Okay, because hey, should I start, back here? Should I start here? Should I start here, there? Where do I start? Okay, so this makes this all very simple. If we're looking for short trades, short setups, okay, again, we start with market structure, right? Here so let's actually just quickly start there, right? Here from late 24 through January and very early 25 and early February, right? We have what? We're in a range. So we're basically in a channel, non-directional. Okay. Now, then we get the sell-off in February. Okay, so the S&Ps sell off, they break a key support level, and we now have, a downtrend. Okay, so we now have a directional market. So that's our first step. We identify that. So we want to obviously be looking for short setups here. So what we do is we take our fib tool, okay, and we start on the bearish pivot. So if we're looking for short setups, we're going to start our starting point is going to be the high of the bearish pivot candle. We already know where that is here on February 19th. There's our red arrow. Okay. And then we're going to draw down to the next pivot, which is going to be a bullish pivot. Okay. That one occurred on March 13th. Okay. So that's going to be our next pivot. And we'll just extend this over so we can see the whole thing here. Okay. Right. So again, for short setups, we're simply starting with the bearish pivot, waiting for the bullish pivot, which came in on March 13th. And then we draw from that price level. In this case, that's about 61.6850 down to the bullish pivot price level of 55.0750. Okay. All right. We now are waiting for a short trade opportunity. And at a minimum, when we're doing this on a daily chart, we typically have at least 3 days of advance notice. Okay. Before we know where to get in. Okay. So where do we get in? What has to occur for us to take a short trade? I'll show you. Okay. So we've correctly drawn our Fibonacci tool. And again, this is where a lot of people make mistakes. Okay. They don't use the correct start and end point. So we've already accomplished that. Now we're waiting for a pullback, and we're going to look for a pullback into the golden zone. And when I say into, so remember that golden zone is 0.5 to 0.68. So there's our 618 level. It merely has to touch. So here again, this is our zone. Just draw it for you here. The lower range of the golden zone. So it doesn't have to go inside, but it needs to at least hit that 50% retracement level. But we're looking for a rotation up into the golden zone between 0.5 and 0.618. This question will inevitably come up. So what if it breaches the 618 a little bit? That's fine too. I'll show you what the disqualifier is. So like if we had come up further and just slightly breached the 618 level, that's fine. The disqualifier is a close above the 786 level. So had the S&Ps rotated up and closed above this level, then we would no longer look for a short entry. Okay, it disqualifies the setup. All right. So we've met a couple criteria already, right? We have a bearish pivot, we have a bullish pivot, where the market structure is what? Downtrend. We have the retracement. We've now tested the golden zone here on March 25th. Interestingly, so this is a very nice to have, not entirely required, but we have a bearish pivot. So these are bread and butter trades. If you get a bearish pivot like this in the golden zone, all the better. Now, our entry is then going to be below the 382 level. Okay, so this is our entry. Right at that 382 level. It's slightly below. So as I was pointing out previously when we were just looking at the pivot methodology, where we use a sell stop below the low of the 5 candlestick pattern. Here we're just using a sell stop below the 382 level. Okay. And so that way, an aggressive trader might just go ahead and short in the golden zone. Okay. So you could have shorted, up here around 58.38, let's say. The trade-off is you give up a little bit of that range but it will keep you out of bad trades because had this not just been a counter trend retracement that then resumed the downtrend and it fully reversed, and then we got the disqualifier and we closed back above 786, if you had entered aggressively on a test of the golden zone, right, you would be in a losing trade off the bat. So my method is to test the golden zone and then get confirmation of the trend continuation. So then I'll use a sell stop down below the golden zone level. So in that case, again, it was right around 57, 58.50. So, we could throw in a sell stop maybe down, maybe 57, 54, 53, whatever. Okay, just maybe a few handles below that 382 level. So again, 382 levels are entry just below. Okay. Once we get a confirmed entry, as we did in this case, okay, our stop is either going to go, I use kind of two levels, partly depending on the strength of the trend, other variables like did I actually get a bearish pivot in the golden zone like I did here? This one looks like a very strong setup. I might tighten up my stop a little. So at a minimum, stop goes above 618 once you get the confirmed entry. And then we'll also take into account volatility, right? If it's a volatile asset, I might also use a wider stop. So this could be stop level 1. 786 is remember, that's our disqualifier level anyway. 786 is our stop 2. Okay. So you can use either one of those. Very volatile assets, use stop 2, set the 786 level. If it's a less volatile security, or a very well-defined downtrend, you can use the 618 level. Okay. And then our profit target is the 0 level. Okay. So we're going to, the very least, I'll scale out at this level and maybe take profits on half the position and leave the second half open for a runner. This case, that would have been very nice, right? And there you can start using Fibonacci extensions if you'd like. But this is our profit target level, right at that 0. Okay. And here we hit it easily, right? Entry would have been probably back here. Okay. And you have a beautiful, like 250 handle move in the S&Ps. Okay, so that's a short setup. So for a long setup, we can just kind of go a little further here, right? We're going to be drawing our fib levels starting from a bullish pivot. So what's the market structure? Right? We had a prior downtrend, and there we go. Right, prior downtrend. We then rebound back in early April, but then failed to put in a lower low, right? We didn't break the April 7th lows. And then we start to reverse. And then we broke through the April 9th and 10th highs. So this is a reversal in trend, right? We took out the prior swing high and trend has reversed. So what do I want to start looking for? I want to look for long entry setups. Okay, so I could just take one of these bullish pivots. Here's one on May 7th. Okay, this is where I start my fib levels. And then what do? I draw up to the high of the next pivot, which is going to be a bearish pivot. Okay, this one on May 20th. I'll just extend this out so you can see it a little better. Okay. And then this back up. Okay. All right. So now we know, in this case, what, 1, 2, 3, like 4 or 5 days in advance, where we are going to enter if we get the next confirmation that we need, which is a retracement into the golden zone. So here's our 50% fib level. There's our 618 level. This is the golden zone here. Okay. There's our retracement into the golden zone. Now, when price comes down there, we want to start paying attention, right? If we had continued to rotate lower, here's our 786 level. If we close below this level, we're not going to take a long trade. Okay, but here we perfectly retrace into the golden zone. Then what do? We go ahead and set our buy stop order above our entry, which is the 382. Okay, so we're just going to put a buy stop just above that level. What did we get? Beautiful. We get another bullish pivot. Exactly what we're looking for. Okay, right out of that golden zone. Buy stop, we enter long, and we take our profit target at the zero level, hit that just two trading sessions later following the entry. Beautiful. That one's good for what? Like a, 160 handle move to the upside. Okay. Remember, stop can go down below the 618 or below the 786 once you get a triggered entry. Let's look at some other examples. So we're looking at futures. Let's look at a stock. Let's see. Look at one of my favorites, Micron, which is actually headquartered out of where I live. So let's just pick one out here. Try to find a recent one. Micron just went on a tear in September. See a nice bullish pivot there. Reported earnings this week and gap down a little bit. Have a couple bearish pivots up there, but let's see. Let's look at okay, so remember market structure, right? We'll look at this one. It's pretty obvious there. What's prior market structure? Downtrend, right? We're making a series of lower highs and lower lows. Okay. Again, this is what helps you stay out of bad trades. Okay. Here was a retracement in early August. And in fact, it looked like maybe it was going to resume here, but it didn't. It went higher. So we never got a bearish pivot. Okay. We're still in this bullish pivot setup. And there we go. We take off to the upside. Now the trend has changed because we just took out the prior bearish pivot here on this day. So now we've reversed from a downtrend to an uptrend. And what do we want to do? We want to look for bullish setups, long signals. So let's get our fib tool ready. What do? We start at the bullish pivot low. It's going to be right around this 103.50 level. Okay, we're going to draw up to the high of the next pivot, the bearish pivot here on August 13th. I'll just extend this out here. Okay. And then we are going to wait for a pullback into the golden zone. So where's our golden zone? Right here, 0.5 to 0.618. And sure enough, there she is. This happened on August 20th. And what do we know? We get another bullish pivot. Beautiful. Okay, so entry above the 382. Profit target's going to be up here at the zero level. Occasionally, I will use the 236 to scale out of half the position as well, just FYI. Here we got some nice follow through early on in the trade. Then we actually got a retest, pull back into the golden zone. Remember our stops, if we're aggressive with our stop below the 618, we want to widen that up. We go below the 786. Okay, so we're still good. We just got a little bit of a pullback early on in the trade cycle, but we get another bullish pivot right in the golden zone. So we actually had two bullish pivots right in the golden zone. I mean, these are very powerful setups. Okay, we could even add to the position and do another entry if we hadn't fully allocated, as long as we're not exceeding our risk tolerance, right? We can even add to the position. There was another entry opportunity here, so we had two entry opportunities, 1 and 2, and After the second entry opportunity, literally a day later, we hit our profit target. Okay, so again, I could scale out, leave the second half of the position open for a runner, trail up your stop to the entry price level, and you have a beautiful trade. Let's see, just checking time here. Okay, got a little bit of time. Let's look at one more stock real quick. I'll look at some other markets as well, but I want to give you plenty of chart examples so this really sinks in. Let's look at advanced micro devices. Let's see. Let's just go back a ways here, pick one out. All right. So market structure is what? Downtrend. Okay, we're making a series of lower highs, lower lows. All right. So let's see. Let's find a pivot here. Okay. This is a very short one. Let's see if this works. Let's see, February 4. Okay, so what did I do? I simply started my fib level at a bearish pivot high, extended it down to the bullish pivot low. Okay, I've now got my levels. This is a little tight. I probably should have zoomed in, but our golden ratio, our golden zone is right here. Okay. Again, we're in a well-defined downtrend, so we're looking for short setups. We get a retracement right into our golden zone, slightly breach the 618. That's fine. Remember, we just will only invalidate the setup if we close above the 786 level. That's this level here. Okay, so we're in the golden zone. We place our sell stop below the 382, and then we target the zero level for profit. There's another nice setup, short setup on AMD. I was going to do a long one too, but let's get out of the equity market and go over. So we looked at futures, we look at some equities. Let's look at some Forex, Euro. We'll look at the Euro US dollar. And let me just find one here. I'll just kind of stick in this area of the chart. Let's see, this one actually looks good. Okay. So what do we have? Market structure, right? Uptrend. So we're going to be looking for long setups. So let's start with our March 27th bullish pivot. We start our fib level at the bullish pivot low. We then draw it up to the bearish pivot high. There's our red arrow. Okay, we've now drawn accurate fib levels. Let me actually just get a little bit further here so we can. Okay. All right, so what are we doing? We're looking for a retracement into the golden zone. So there's our 0.5 level, there's our 618 level. There is the retracement in May, early May. Okay, we don't want to get long yet because this uptrend could reverse. There could be a shift in supply and demand, and then we get a sell-off in the euro dollar. But sure enough, we retrace right into this golden zone, and we start to catch a bid, and we get what? Actually, a couple bullish pivots. Place our sell stop above the 382 level. We get a trigger. Probably going to gotten the fill here on May 14th, if not by May 19th. We're in a long trade. Okay. And we're targeting the zero level. Remember, stop. You can put below either the 618 or the 786. It never even got close. And we're targeting the zero level. And beautiful. Hit our profit target June 12th. Okay, so yeah, this works on any asset, doesn't matter. Forex, futures, equities, ETFs, metals. Let's look at silver. Let's see here. Let's go back to like a prior year. Let's see. Go back even further. But there's just an abundance of trade opportunities here. You could, if you know how to use this. So just using these pivots with fib, I mean, it's incredibly powerful. Let's see. Let's do this one. So this is a bullish pivot. So right, we have, what's the market structure? We're in an uptrend. Okay, so we're going to be looking for downside retracements and long entry setups. So let's get our fib tool here. So we're going to use the March 26 bullish pivot. Okay. This probably would have been some other nice opportunities in here as well, but we'll just start here. Let's just say we missed some of these. March 26th. So we're going to start our fib level at the March 26th low. Now we need to have a bearish pivot to extend to for this to work, right? So we have one of those on April 12th. Okay, so we're gonna extend that up to the bearish pivot high. Okay, and then we're gonna identify our golden zone, 0.5618. There's our golden zone. Okay, so starting looks like what? Mid-April? Yeah, right, kind of mid-April. We start to retrace back down. Okay, here we reach the golden zone. So and we actually get a bullish pivot. So at this point in time, we can place our buy stop above the 382, but we don't get follow through. We actually continue to retrace to the downside a little bit more. So we're back in the golden zone. Okay, we breached the 618 level a little bit. Again, that's perfectly fine. We just can't have a close below the 786. That did not occur. Okay, so we're in the back in the golden zone. Another bullish pivot. Excellent. Okay, we start to rotate higher. Silver starts to catch a bid. We have the order would have been in place from back here in April, right? If we use the GTC, good till canceled, we still have our order working for us. Would have been filled right there on May 9th. Okay. We define our risk, so we go and throw in our stop. And our profit target is right up here, around the 27.25 level. And this would have been a great trade. We almost did it here around mid-May, but then gapped higher. So here we would have had a nice gap higher trade past the zero level. So we would have actually exceeded that by quite a bit there. So there's an example on the metals. That was silver. What about crypto? Let's try it on Bitcoin. Let's look at Bitcoin futures. And I'll just do this one real quick here. Let's just stay in 24. Let's see. So here's a bullish pivot. Okay, we had a prior downtrend. That's the market structure. But on September 27th, the trend reverses because we took out the prior bearish pivot high from back on August 26th. Okay, so we're now going to be looking for long setups, right? And what do we want to do? We want to draw our fib level starting at the bearish pivot low. And then we want to extend that up to the, bullish pivot low, extend that up to the bearish pivot high. Okay. Now we're waiting for a pullback into the golden zone. Where's our golden zone? Right here. Okay, 0.5618. We get a pullback here in early October. Sure enough, we get another bullish pivot. We get the follow through. Our entry is going to be right here above the 382. And we're going to target a profit up at the zero level around 67,135. Easily hit that just 2 days after the entry. So entry would have been here on October 11th on the long side, hit the profit target October 15th. Beautiful. Okay, that's crypto. Works on crypto too. Okay. All right, so I hope those examples were helpful and useful. I'm now going to let you know how you can get the price action pivot indicator for yourself on your TradingView charts. Okay, it's going to give you accurate buy and sell signals with zero lag. You get the proprietary pivot algorithm. It reads the market in real time. It's going to also include exact entry, profit target, and stop loss levels on your chart. If you want to just trade with the pivot indicator as a standalone. Okay, it's going to forecast short-term and long-term trends with astounding accuracy. It doesn't repaint. Okay, so once you get a confirmed bullish or bearish pivot, it's set in stone on your chart. Okay, it has built-in protection to avoid whipsaws. It captures most of the trend before it reverses. It's designed to limit losses and let your profits run, and it can be used with any other indicator system for added confirmation, like we did today on our session with the Fibonacci retracement tool. So ultimately, it's going to help you trade without any guesswork. You're going to know exactly where to start your fib levels, where to end them, and where to look for those retracements before you jump into a directional trade. We developed a whole 2-day workshop just on price action pivots. I had an opportunity to cover them briefly today, but there's a whole lot more really cool stuff that goes along with what I showed you today in the session. So you're going to get access to our 2-day price action pivot workshop as well. So the link to join this is altostrading.com/PAP49. Why PAP49? Because you literally get this incredibly powerful indicator for your TradingView charts for only $49 a month. Okay, pennies a day. So again, altostrading.com/PAP49. David put that in the chat for you guys, so you can just click right out of there. You can join and get the price action pivot indicator on your own charts and start using the methodologies that we covered on our session today. I again hope it was helpful for all of you. Please do lock in those seats. This is a discounted rate. We normally offer this indicator at $149 a month. So you are getting a significant discount for being here today. Again, altostrading.com/PAP49. Thanks, David, for getting that in the chat. I only have about a minute left. I apologize I didn't have enough time for Q&A, but I really wanted to make sure I covered all of the strategies, tools, and methodologies on the session. So here is our contact information. If you do have any questions after today's session, you can always reach out to us, support@altostrading.com, or call our friendly customer support team at 800-895-9348, and be happy to answer questions for you if you guys have any. David, just want to thank you for having me today. It's always a pleasure. Thanks to all of you for attending. Again, I hope you got a lot out of the session and hope to see you on the next one.